I only have 10 minutes, so I have to very briskly go through the Copperbank strategy and philosophy. When we launched this company 3 years ago, it came with a very specific focus. We are all investors that wanted direct exposure that's not dilutive, going to be highly accretive in copper. Please read the forward-looking statement. Our technical team has over 350 years of experience. They are geologists and engineers supported by the investors. We have not diluted the structure until this year when we felt that the copper price was becoming interesting. Copperbank owns 3 businesses. So when you look at that as an investment, you have to look within the theater of your mind, imagine, and we're highly motivated to do this, we are going to spin out the 3 projects and create share dividends for our shareholders. The reason we like copper at this point is part of the philosophy. It is going to decouple from many commodities because of the electrification of energy. You see in the graph here, over 2 years, it's decoupled from oil, it's decoupled from gold. And if we go back to the all-time high, it was $4.50, $10,000 a ton. 2 weeks ago, Oscar Landereche, the chairman of Codelco, feels that we are in deficit and we may see $10,000 a ton in 2018. The important thing to glean from this graph is that all the action in the juniors occurred at around $3.50. Let me show you the long-term oil price. They travel like one monolithic group. Oil, even today, is a $1.8 trillion market, and what oil does, 90% of the time, the other commodities, particularly copper, does. I'm going to layer now the copper graph to this oil chart. Up and down at the same time until now. Copper has decoupled. The question is what will happen in the longer term. If copper 350 was the good old days, and I was involved with 9 copper companies, we sold 8 of them, and 350 was the average price. That's kind of like suggesting oil at $100 where a lot of commerce happened with that commodity. We're now trading at 320. We are a whisker away from where a lot of activity. There are 30 examples of junior copper companies that were purchased between 5 and 12 cents a pound in the ground when copper averaged 350. So this has happened very quickly. I think this price run has happened quicker than most people think. In fact, our strategy was supposed to be a 2019 or 2020 strategy, but this is manifesting itself. And as we see the copper price following it very carefully, if it does continue to be at these levels or stronger, it makes the impetus for us to accelerate our business model. We believe that copper will be the only major commodity that has significant demand growth. We feel 45 to 50% of new demand growth in the next 20 years. And this is based on electrification, not just EVs, but I think it's the greener and cleaner the way that we're utilizing and transferring energy. Power of magnitude, 500, 600% more copper per megawatt. In the last cycle, we spent lots of money. I was involved with some of these companies. 150 billion was invested in drilling, exploration, feasibility studies. No real success. This is what we bought, the gray bars. Projects that already had a lot of money spent on them. If you want more information on energy, I did the keynote at CESCO this year at the Copper Dinner. And my statement to the copper industry was, you are in the energy business. Start promoting your business as such. If you look at the comparison, certainly the demand of copper is different, but the supply more so. The world's oil supply comes from 4,700,000 individual wells. 45% of primary copper comes from 20 mines. They're different. The very thing that makes it possible to go away from fossil fuels is this copper. These are the 20 largest copper mines listed from 2016. Escondida, the famous one, the largest one, and the workhorse mines that produce typically 200,000 tons a year. These mines have been high graded. What is the grade of these mines and the future of copper? You can look at the sources of copper. It comes from 3 places. Recycling, which is approximately 4 million tons. This can change. Cathode copper, which is 2017, will come in at about 4 million tons. And concentrate copper, which is 16 million. This is the 24 million tons of primary and secondary supply that we will see in the year 2017. Cathode, I will suggest to you, will fall below 3 million tons in the early 2020s. It is all picked over. So if we know that demand is going to grow by 3 or 5%, you can choose your own adventure. We believe it's going to be somewhere closer to 4 or 5 CAGR for the next 20 years. This is where we see supply. The industry has not invested in future supply. You can toggle these numbers as you wish. You can be more conservative, but the delta between the supply and demand is where we live, and it's a function of price. People don't believe that 0.5% copper is the future of this industry, but it is. I list you here various projects in production and what could be in production. And as we go up the food chain, I will suggest to you that 0.5 or 0.6% copper equivalent is really the sweet spot of this industry. Kamoa is an outlier. The days of 1% copper are gone. The top 15 copper producers in 2010, average produced metal grade 1.2%, today 0.72. If you're mining 30 million tons a year, you now have to mine 40 or 45 million tons, same metal yield. I use this colorful example for people that don't understand copper. If you have 1% copper, what is a ton of this rock worth? Well, it's $3, it's worth $66. If you're a mining engineer, you have to make all your money with this scenario. The problem is we don't mine 1% copper. At 0.5% copper, you have $33 to work with. That's it. It's not a business. BHP, the largest integrated miner in the world, tells us we need $3.50. If I'm more generous and it's $4, it's worth $44 a ton. It comes down to Capex. Capex, there are 15 or 20 different line items in any PEA or any PFS. Your MPV should be higher than your Capex, and this is a very difficult thing to occur. We, at Copperbank, have 2 such projects. And the Capex, typically, these projects are 3,000, 4,000, 5,000 meters in elevation, up to 1,000 kilometers from deepwater port. We have 2 case studies. We have 3 projects in Copperbank, and what I want to hopefully encourage you to do some deeper due diligence in our 2 development projects. Case study number 1 is Pyramid, located in Alaska. It's on deep tidewater, located on private property on the 55th parallel, roughly Prince Rupert, British Columbia. It does not snow here. On the drill site, we'll have a little bit of winter snowfall, but there's no ice. We believe this project will be very favorable with respect to advanced economic studies, a preliminary economic study. When we purchased the project, the resource was not big enough. We did some drilling this summer, and I believe we've been successful there. You can see the drill map here. The red traces was previous drilling. The green traces are what we did this summer. We did this for $1.8 million, or $440 a meter, very cost effectively. These are the 3 conceptual pit shells that we have. You can see the drill holes that we put into this conceptual resource model. And this is looking at side view. The drilling that already occurred, the hole in the far left, 20 meters of 1% copper, not in the resource. And then the middle area, of course, needed to be infilled. These are the exact holes that we drilled, and here are the results that we put out. Starting on the left, we have 300 meters of 0.53% copper with a 40 meters of 1.17% out of the pit resource. There's a total of 1.1 kilometers of direct hits, and the resource is now 1,700 kilometers. If I show you a side view, the hole in the middle is that 37. This basically ties together a good portion of the deposit. So effectively, we want to see if we can increase this resource, see what a 12 or 13-year mine life would look like, and come up with 2 ways to evaluate the project: pounds in the ground or a percentage of the MPV. We believe that the local logistics will lend to very favorable economics. Our second case study is a copper oxide project located in Elko County, Nevada, also on private property. 86,000 meters has already been drilled, and the MPV of this project, when we bought it, was exactly 0. At $3.20, based on the September 2013 feasibility study, using a 35% tax rate after tax, 8% discount rate, is about $105 million. How can we increase the efficiencies looking in 2 scenarios? None of the higher grade in 2013 converted to reserves. If you look at the pink areas, this is 0.5 or 0.6% copper or higher. 2 scenarios. 1, we have low copper prices in perpetuity. Can we make enough money with the high grade core that we could then go and heap the balance of the lower grade material? If you look at the feasibility study, $188 million capital expenditure, 10-year mine life, and this is how we're going to torque the engineering. The Capex, starting at the top, they wanted to use a mine fleet, $50 million. We want to use smaller scale, 10 to 15,000 tons a day, potentially contract mining. There's a potential to have a used SXEW plant here. Many of them are going into reclamation, and of course the contingency is rather aggressive. So we believe this project could be built for about $110 million. OPEX is $6 a ton, which is important for $20, $30 rock. At the end of the day, can the MPV be greater than the Capex? I encourage you to do more due diligence. We do have some appointments tomorrow morning, and if you look at the project, we're going to deliver lots of news, and effectively, these are the 4 businesses, $25 million market cap, and I will show you the exit strategy and how we will finance this that will be not dilutive, but very accretive to Copperbank shareholders. Thank you.